So let's start off with the way things have been going in 2015 so far. And it's really been already the year of currency volatility. We've had the Swiss franc move. We've had the ECB doing QE. We've had various other countries in the rest of the world trying to fill with their pegs and bring their currencies down. Is this a case where it looks as if central bank policies are going to diverge this year, and thus, for the first time in sort of 6 or 7 years since the crisis, we're going to have some significant yield gaps between the currencies, and that's what's driving it? Ashvin.
I think that actually is the central theme that we should all focus on. I believe that central bank divergence is probably not only the most interesting aspect of the dynamics of financial markets for the year, but there will be two things that will happen as a result of that. One is they will keep global yield curves low, because even if one of the banks decides to tighten and the other ones are in an expansionist mode, the demand from the other places is going to drive global yield curves down. So one is you're going to end up with interest rates remaining lower for longer. And the counterpoint to that is that excess liquidity is going to provide momentum for equities. So in fact, I'd say you could pretty much read at least what we think will happen in financial markets in 2015 from just that one sentence, central bank divergence.
Rebecca, do you agree?
I agree that we are going to have this divergence. I mean, we have seen one hike, I think, this year from Brazil so far, but otherwise it's everyone going down. And now, after the last non-farm payroll data, the market is giving, I think it's about a 70% chance that Fed starts hiking in June. So the Fed at some point this year probably does start raising rates, which affects the short end of the curve more than the long end. I think with this divergence, though, we continue to have a strong dollar. And that's really important as we think about portfolios from a global basis, because European equities might be outperforming US equities so far this year. ECB QE is certainly good for equities, but if you don't hedge your currency risk as a US-based investor, certainly you're leaving a lot of money on the table. So thinking about how those central banks lead to currency changes, how that feeds through to portfolios, both from a macro level and a micro level, I mean, Procter & Gamble, Pfizer, Microsoft, et cetera. It's not as simple as just putting on a currency trade. You have to really think about it across asset classes.
Carl, as an investor, I mean, is this really currency wars? Is this everybody wants to see their currency devalue, and QE arguably works to the extent it works at all by driving your currency down? How do you take account of that when you're investing? And are the U.S. authorities going to be happy to see the dollar keep rising?
Well, the Fed, I think, is backed into a corner. We think they do lift off in June. If you look at insured unemployment, that the cohort of people that are still insured that we think can still get a job, that's back down to 30-year lows around 1.8%. Unemployment's dropping about 0.1% a month. I know it's lumpy, but I think the Fed must raise. I think they're only going to raise 75 or 100 basis points, and I think the long end, I agree that the long end doesn't move. But this world's a difficult world when you're talking about a multivariable equation. But if you isolate the variables, like, again, US and Japan, that one seems to be fairly, I don't want to say easy, fairly obvious, fairly investable.
But everybody thinks the dollar's going to rise. So that makes me nervous to assume that.
It's interesting, though. If you look at a consensus forecast at the beginning of this year, picking on dollar yen for a minute, so people looking at the end of 2015, the range of forecasts, I think the most aggressive dollar yen forecast within the range was 135. Well, we're already at 118, 119 now. I don't think anyone is baking in a 150. So if we slowly see dollar yen rise to 125, 130, even 135, and it's a slow move, corporations have time to adjust their hedges, et cetera. If we see a faster move in the dollar because everyone else is devaluing, everyone else is cutting rates, and the dollar is the toothpaste in the tube that squeezes up, that's when it becomes disruptive. And if you get a dollar yen at 150, it doesn't stop with dollar yen. You get China probably continuing to devalue its currency. You get Singapore continuing to ease. Everyone has to do the same game so they don't lose trade competitiveness. That's when it becomes a very disruptive event instead of a modest trend that people can work around.
Right. So you might actually say that central bank policy divergence is not only driving the bond markets and the equity markets, but also becomes the source of volatility in markets for 2015, because a lot of the volatility is going to come from currencies and currency adjustments.
Another phenomenon which is quite remarkable for this current period is the existence of negative yields. So the Swiss, when they abandoned the cap, cut rates to minus 0.75%. The Danes have got there in 4 cuts. And last week, Nestlé's bond, never mind government bond yields being negative, Nestlé's bond yields were negative. I mean, how long can that survive? I mean, does it really make sense to buy an investment that will, in nominal terms, lose money? Carl again.
No.
No, right.
That's
so why are people doing
a hard
it?
sale to my investors.
Yeah. Why are people doing it?
Well, I think you have there are 11 countries now at negative nominal rates, and you even see in countries that even have life insurance companies that are matching assets and liabilities, right? And they're actually starting to launch multi-currency platforms that match assets and liabilities in different currencies because they're positive rates. Back to the point you were making, this forces our long end lower, even though we might be raising the front end, because global fixed income has to go somewhere. You know, you look at where the Bund is, and you look at where the 30-year JGB is, and you look at where the U.S. bonds are, and it's probably why U.S. bonds are still going to trade lower in yield.
I mean, you could see with a Swiss bond, if you expect the currency to appreciate, then you don't mind losing a bit on the yield, right? But that can't be true of 11.
But think about when a central bank is telling you that you've had 20 years of positive real returns, and now you're insured to have a negative real return, negative nominal rates. Why haven't the yen all left Japan already?
Well, yes, Ashvin.
I'm going to disagree with Carl. I mean, when he says, no, it doesn't make sense. I mean, the world is telling you otherwise. There's no shortage of demand for these bonds. And so the world is buying these bonds and continuing to keep interest rates negative. So that's one data point. I will say that I think people have forgotten what asset allocation is even all about, because what their prior experience has been 30 years of bonds that have given you good returns and 30 years of equities that have also given you good returns, okay? And the reason you have bonds is for safety. When the world begins to collapse, those bonds save you, right? And so the fact that bonds are incredibly expensive is telling you something. The market is telling you that the world is still uncertain, that 08 is not over. We're still in sort of the middle phase of that entire operation, and that buying insurance is incredibly expensive. So you say, should I walk away from it? And the answer is absolutely no. You buy it the way you would buy insurance at a very high premium. Maybe you buy a little less, but if you cannot afford to take the risk, you have to buy insurance. Now, there's a silver lining to it, and the silver lining is that if you have your safety net and the rest of it is in the equity risk premium, then that's doing really well, because bonds are expensive, equities are cheap relative to bonds, and so there's momentum in that. So the combined portfolio has been giving you a great return. So if you've been invested post-08 in the market, you've got a fabulous return. And so you've got to look at the portfolio in total, but don't walk away from that piece that is very expensive.
Well, I think there are two sub-arguments in there which I want to unpick. But the first one is that bonds are expensive. So
no contest there. Yeah.
Many of us in the room can remember in the late 90s, everybody telling us that Japan bonds were expensive at 1% yields, and it's the trade known as the widowmaker, shorting Japanese bonds. The start of this year, everybody was saying that bond yields were too low and they were bound to go up, and sure enough, they've fallen, just as at the start of 2014, people made the same argument. So if you think we're heading for deflation in the Eurozone, are bonds really too expensive?
Right. No, I don't think the world is buying negative yields. I would not buy a negative yield, but I can see some investors and some market participants either wanting to or needing to. If you think we will have greater deflation, it might make sense. If you're speculating on a currency, it might make sense. If you're a commercial bank or a central bank and you have to have a certain amount of capital and a certain type of asset, it makes sense. I think you can have a defensive part of your portfolio without having to suffer a negative yield. I mean, last year, where we have some fixed income in our diversified portfolios. We're incredibly underweight, and we've put in more money in certain parts of the credit market. So taking incrementally more risk, but certainly not equity risk. Last year, our non-agency MBS securities that we had got us an 8% return. Well, I feel pretty good about that. And it's floating rate. So even on a day like Friday, when we had non-farm payrolls better than expected in the United States, and the US Treasury yield popped on the 10-year from 1.8 to 1.95, our MBS securities were flat. So I think if you can think creatively about the right part of the credit market, US high yield today, in general, I wouldn't be very excited about. But there are pieces in the credit market, particularly floating rate, that I think can still give you some defensive assets in a portfolio without having to suffer negative yields. And I think when you think defensive, hedge funds have gotten a bad rap the last year or so, broadly speaking. I think there's still a role for them in portfolios as a risk reducer and diversifier.
I just want to look at the other part of the argument was spelled out, which is that equities look cheap relative to bonds. It reminds me of the Fed model, which was another very popular asset allocation tool in the late 1990s.
I wouldn't say cheap, but I mean, well.
Right. But, well, we can talk
relative.
about what,
Relative, yes.
yeah, capes and all the rest of it. But why are bond yields so low? Because central banks are keeping policy very easy. Why are central banks keeping policy very easy? Because they're worried about growth. If they're worried about growth, equities, we ought to be worried about equities too. Now, what we've seen in the last few years is that despite very sluggish growth in the developed world, profits, particularly in the US, have been extremely high. And so back to the arguments about, inequality and changing job markets. But do you think, Carl, we can sustain a world in which we have these very low interest rates and very low bond yields, and in which corporate profits continue to rise? Because Japan, what happened in Japan over time is that equities got steadily derated, reflecting those lower bond yields.
No, it's true. And here, we believe that the skilled workers in the US are kind of fully employed. So I think you start to see some wage growth in the US, and I think the Fed's looking for it. So unemployment, despite the participation rate, we know that's terrible. And maybe those people are never coming back into the workforce. Mm-hmm. We've had some other advanced economies that have entertained 10, 11, 12% permanent unemployment. I don't think that's a terrible thing. They're just going to be, wards of the state, and we're going to have to pay for them. But from the skilled workers' perspective, I don't believe in this idea of enormous labor slack with the lack of participation rate. I believe that you're going to start to see wage growth in the skilled side, and therefore profit margins come down a little bit.
Ashvin, how do you react?
Yeah, so in the end, you can't just have multiples that don't make sense. Eventually, there's mean reversion over the long time. So, future rates of return are bound to be lower, right, by definition. And you know that the way you sort of look at your return on equities usually is, do you go in at a good price? Because if you don't go in at a good price over the cycle, you don't get a good return. So you'd expect that to come down. On the other hand, there should be a lot of differentiation, because whenever you have dislocation, there's a lot of differentiation. So you have multinationals with good balance sheets, a strong dollar, declining energy prices. The decline in energy prices is, in a low inflation environment, has got to be a mega booster for growth. And so this is not a bad time to be in equities.
So you would take that argument rather than the fact that you could see three indicators of the economic health: bond yields, which is falling and telling you should be worried about growth, and commodity prices, Dr. Copper and all the rest of it, which are falling and you should be worried about growth. But then they're not things to worry about. It's the equity market that's still strong, so that indicates that growth will be right.
So there are conflating factors, right? This is exactly the point. It's an uncertain world, right? You're trying to get out of it by pumping money. It's a monetary expansion. That's bad. You want to have a strong economic expansion. You're not getting there. You've got there in the US. You haven't got there in Europe. Europe's in trouble. But now you have this sharp decline in energy policy, right? Energy prices, and a lot of commodity prices. Some of it may have come from China, which is, China slowed down, which is another indication that global growth is low. But on the whole, the decline in energy prices, which has come in part from a revolution in fracking technology, and then Saudi Arabia and others saying, gee, we're not going to give up market share, so we're going to lower the price, and they can keep lowering the price to a very low number, that's a tremendous boost for growth. So short to medium term, I don't think there's a reason for panic. It's an uncertain world, but you want to be diversified. You want to have your safety net. You want to be in the equity market, but globally diversified. The short-term momentum is in the US with a strong dollar, but medium to longer term, the rest of the world is offering more value.
This is just a follow-up question I didn't warn you about, but just when you talk about it, US pension funds assume 7.5 to 8% annual returns. In a world where treasury bonds are yielding less than 2%, and good corporate bonds maybe 4% if you're willing to push up the credit spread, how can you assume that?
Yeah, that's a problem. I think going forward, every calculation will tell you that future returns are going to be lower. Yeah. And so anytime you're stuck between either a legal framework or a structural framework where you're not going to be flexible, you're going to run into trouble.
That's definitely something that one needs to watch, not just in the US, but in Europe as well, with the declining bond yields and having had a lot of these pension funds as clients in previous years. It was very difficult for them within their institutions to change their target return. It was politically challenging to change a target return, but it becomes less and less tenable. I mean, the 10-year yield was over 11% 30 years ago versus 2% if we're lucky today. So just mathematically, getting to that outcome gets harder and harder. And it is going to be something that weighs on corporates and share prices for some of these companies where it gets egregious. So it is something to watch with a feedback loop back to equity valuations in the broader equity market if you have enough large multinationals with real pension problems that start eating into balance sheets.
Yes, well, often they say, well, we've earned 8% in the last 30 years, so we'll just carry on doing it. But it's a worry. I want to pick up on another point that Ashvin was just talking about the central bank policy. This is the land of the free, the home of the free market, and yet it seems that investors care more about what central banks will do. We care more about Janet Yellen and Mario Draghi's policy changes than anything that politicians do. And it's almost as if investors are on welfare waiting for the next handout from the central banks. And how do we get into this position, Carl, and how do we get out of it again?
Well, I don't think you can get out of it, but I think that they can keep going. And I make this point frequently. I think the unintended consequence of QE has been to widen the income gap, right? The people that QE's ended up being distributive, and it's distributed to the rich people. How many rich people do you know today that are poorer than they were at the peak of 06 or 07? And I don't think I know any. So the rich people are doing really well, and the gap's widening.
Dick Fold, maybe.
Okay, I didn't want to grave dance, but yeah, there are a few people that are a little poor, but they're outliers. But I don't think we can get away from it. I think that once you enter this kind of policy, you must stick with it. And the next recession here is going to be a tough one, because we're going to have many fewer tools to use in the toolbox to avert a severe downturn. But I actually think that this year will be plus or minus 0 in the equity markets here, and maybe that'll be an interesting marketplace.
And Rebecca, how do you make decisions about asset allocation when everything is really dependent on the central banks? You could throw away all your economic data, except to the extent that it makes Janet Yellen decide, and the rest of them on the Fed committee, when they're going to raise rates.
Yeah, I mean, we're focusing more, I think everyone is focusing more on understanding the secret language of central bankers today. Whether we're looking at the word patient for the Federal Reserve, and if that tells us that a move is 2 months or 2 meetings away, or if we're looking at the ECB at a certain word they might use. Trichet had some wonderful ones. I miss him for that over at the ECB. So it does become a bigger part of the equation, but I don't think that means economics don't matter. You still care about company profitability. You care about management teams for companies when you're doing security selection. Credit still matters. You still care about the economic data. So when I look at the world today, the United States has momentum. We have real momentum. And so even if the Fed does need to tighten, and I agree with Kyle that they need to tighten, at some point we're going to hit another recession. And if we haven't normalized rates somewhat, what do we do to cushion the blow then? Yes, our budget deficit in the United States is smaller today, so we could have fiscal spending, but part of that will depend on the political climate at the time. So I think that you do have to spend time with focusing on the central banks, but the other stuff does still matter. And in the US, I think the economy can withstand slightly higher rates this year. And the beautiful thing is we're raising rates from such low levels, and the long end of the yield curve will stay low. So even though we have tighter monetary policy, we still have pretty attractive borrowing levels for households and corporations. So this tightening cycle might not be as onerous as some in the past looking at a historic model. This time is somewhat different, with the long end staying low and starting from such low levels. So I think the economy will withstand higher rates and could keep doing well. US equities might benefit from that for another year or so. And I think margin compression, we're seeing that more in the small and mid caps than the large caps so far, but I agree at some point that comes back.
But Ashvin, it raises a question about asset allocation again. Let's say the Fed was unexpectedly forced to tighten much more swiftly than anticipated because wage growth takes off, say. That's going to hit not just equities, it's going to hit corporate bonds, it's going to hit real estate. I mean, if you've got a diversity, and it'll hit private equity and maybe some hedge funds. Yeah. So you've got a diversified portfolio, everything turns to dust in those circumstances, doesn't it? The diversification doesn't help.
Well, I think we've chatted about this, that I actually think that asset allocation as a concept is misunderstood. The purpose of that is really diversification around a portfolio. And we've got used to thinking that bonds and equity is an asset allocation, right? Because both of them were actually doing well for the last 30 years and allowed us to diversify. We've done some work around the fact that you should really not worry about the markets that much. You should be, as an individual investor, you should figure out what your goals are and then devise a strategy around those goals. And you really need to think of your entire portfolio in 3 different ways. A safety net, where if bonds are expensive, tough luck. You go buy them. Your home, pay off your mortgage, things like that. Then get a market portfolio, get the equity risk premium there, distinguish between permanent loss of capital and volatility, and take the full risk there. And then an aspirational portfolio where you have your business or stock options or leverage, because the market portfolio is not going to make you rich. So I think people need to go back and go to the basics and think about risk and resource allocation, and almost think of asset allocation as a technical term within investments.
Okay. I want to cover one more topic before I ask a polling question, and that's liquidity. So I always think I think this is a Texas thing, a story I remember from the 90s, which was a rowing boat full of, a pleasure boat full of elderly sightseers who were going through some lake in Texas when they passed a nudist beach. And everybody raced to one side of the boat and the whole thing capsized. To look at and you can think of markets a bit like that everybody goes into these great new assets that people have dreamed up, whether it was subprime mortgages or whatever, alternative real estate, there's always something. While everybody's getting into it, it looks fantastic. Of course, it's not correlated and it's going up. But when everybody wants to get out of it, then that's when disaster strikes. Now, where are the liquidity worries at the moment? If you had to sell, Carl, a big part of your portfolio, what would be the bit that you would be most worried about selling, without naming any stocks?
Yeah, no, equities would be the toughest.
Really? Not corporate bonds?
No.
Is that because you don't own any corporate bonds? Or?
No, we own some. We own some. I think those are today, right? Yeah. But today is a different market.
Okay.
And I think by the way, I think that boat was on the Thames.
Oh yeah. Didn't know the Thames was through Texas.
No, I think some of the mid cap, small cap equities would be really tough. It's we have a saying in our firm. On the way in, it's a 5-lane highway. On the way out, it's a goat trail. And we saw that in EM, and she mentioned that Brazil raised rates. Brazil didn't raise rates because their economy's booming, right? Their currency's collapsing, and they're trying to hang on. So, Brazil is a great example of everybody piling into Brazil's sovereign debt, and then they couldn't get out when it went the other way.
Ironically, 5 years ago, they were complaining that their currency was too high.
Yeah, yes. They actually put up roadblocks.
Yes, that's right. Rebecca, what are you worried about in liquidity?
Municipal bonds probably could be interesting if rates rise and people get nervous about that and want to get out of certain of them. And anything with a yield, especially in the corporate bond world or more esoteric parts of the fixed income and credit market. I guess a tangent, I spend a lot of time worrying about ETFs. You know, if you go back 20 years, ETFs were about 2% of US mutual fund assets. Today, they're 35%. And I think some ETFs are absolutely reasonable. I own some in our clients' portfolios, but they're not all created equal. It sort of reminds me of structured notes from the 2000s before the last crisis. Some of them have dodgy counterparties. Some of them have unusual methodology. And I think a lot of retail investors have gotten into them thinking it's liquid. It'll always be liquid. We saw in May and June 2013 with the taper tantrum when the Fed hinted at rate hikes, the premium to sell some of the better known liquid EM, emerging market equity ETFs, was as big as 1 or 1.5% just to get out. And that wasn't that big of a dislocation. So I wonder if we have a real dislocation, what's going to happen? And I think there could be some shocks among the retail investor community with some of the ETFs.
And Ashvin?
I actually think the liquidity risk is ever present. I mean, even if you look at the 10-year US Treasury, which is incredibly liquid, you see that on days when you know, the risk trade goes off, I mean, that thing moves like you haven't seen it in recent
There was a 23 basis point move in minutes, wasn't there?
And this
40.
40, was it 40?
This is
In the
becoming-
swaps market, there was 40, and you couldn't trade a swap.
So you look at the US Treasury market and you see those kinds of moves on a daily or a weekly basis. You know what's happening. Everything is hidden. The liquidity risk is hidden as long as there's an easing of monetary policy. As long as money is being pumped in from either the US central bank or the European central bank or the Japanese, if somebody's pumping money, it flows in, it hides the liquidity. The day everybody looks around and says, I don't like the market, liquidity disappears even in the US Treasury market. So I think you really have to go back to the basics and say, why do I own this? If I own it for safety, Treasuries. If I own it for return, I better not need the money tomorrow because I'm buying in a liquid market, and when the liquidity goes away, there won't be a buyer, or there'll be a heavily discounted price at which I sell it.
Right, now we have a polling question, which I hope is going to be put on screen, and it's on big data again, so we're slightly changing subject, but so you have to go to this. This is how to answer the poll. Hopefully you've all got pads. Right, and this is the question, snappy. Which of these is the most accurate assessment of the role big data will play in guiding investment decisions at your organization in the next 5 years? There are 4 options. I shan't read them because I'll lose my voice. Okay, can you all vote now? It's a fair bit of big data just analyzing this.
Yeah.
These questions. Here we go. The answers.
Oh, real time.
My colleague Ken Kukli will be delighted. Big data will be essential to integrate into our decision making, but only as an additional input in the process. God. Oh, no. All right. Oh, no, people are catching up. Right. So, gosh. Okay. I think that's the winning answer, and we'll leave it there. Right, a chance for questions to the panel, and there's a gentleman there already. And yes, anybody raise your hand so we can send the mic round.
Do the panelists think that the perspective or the future imposition of capital controls, international capital controls, is an underestimated and unappreciated risk in the asset allocation or investment process?
Kyle?
Yes, I think. A funny anecdote about that, when Iceland put up their capital controls, I went and met with the finance minister about 6 months afterwards, and he was explaining to me how the capital controls would be off in the next year. And he pushed a packet in front of me that showed me Icelandic debt to GDP at 87%, and I had S&P data with me at 158 or something percent, and I said, how do hey, you know, my numbers must be really bad compared to yours. How do you, and he says, well, the Nordic loans and the bilateral loans that were made directly to the central bank, not to the governments, we don't count those. And, you know, and this was the story Iceland was giving you as to why you should invest in Iceland and therefore the capital control should come off, and they still haven't come off, right? So I think that's the break glass option, right? If the monetary policy doesn't work and if currency moves become more asymmetric, that's the break glass option, and clearly that's in the playbooks of the central banks.
And it seems like it's becoming more acceptable among the international community. I remember back in the day in Asia, I was living in Singapore for several years, and capital controls, you just wouldn't even discuss it. Of course, you have to have a free-floating currency, maybe a managed peg. And it's interesting with the case of Iceland and thinking about some of the other countries, you don't get the reprimand from the IMF or other international organizations on capital controls that you used to. So it does feel, I'd agree with you, Kyle, that it's becoming an acceptable part of your toolkit as a policymaker. And
we might have Greek capital controls within a few weeks. Yeah. Ashvin. Another question?
There's one in the back.
I'm good. Oh, yes, there's somebody old part raised their hand. Oh, Stan, go on, yes.
Yeah, just Grexit. You kind of alluded to it briefly, but how does it feature in your thinking?
Okay. Ashvin,
sorry,
start with you
didn't
this
catch
time.
the question.
Grexit.
Grexit. Grexit
Yeah.
rather than Brexit, right?
Brexit, yeah. So look, I mean, I don't think the European Union wants Greeks to exit, because if they do, that just starts, then you go to the next set of countries. I think this is a good test for the system. Everybody understands it. There are great benefits for being part of the union. So I think there will be some political posturing, but it's not going to happen.
I want to take that one.
Oh, yes, Carl. Go.
So look, when the official sector lent to Greece, first of all, has anyone ever seen the IMF lend in a subordinated role? I haven't. So they're in a subordinated role in the Troika. And when the IMF made that loan, IMF policy from an SDR perspective used to be they could lend 200% of your SDRs. Then in the crisis, we got that raised to 400%. What percentage of SDRs IMF lent to Greece in the first loan? 3,200%. Did anyone think the official sector was ever going to be repaid? No. Even the IMF knew that, right? So the key is how are they going to erase that debt? Are they going to term it out? Are they going to put an interest moratorium for 10 years? Are they going to make the rate 0.1%? However they do it, the official sector is not going to get repaid in full. And it's just a question of how they do that vis-a-vis. The IMF's not going to have any say in it, which is interesting. So,
But is that, I mean, it seems to me that that's not the problem, the debt. I mean, it's already, 16 years average maturity and a very low interest rate.
That doesn't matter.
It's the reform program.
Right, reform fatigue. I mean, there are a lot of countries that have been taking the German medicine and having fiscal austerity and trying to get their houses in order since '09, and you still have unemployment rates 25, 30, youth unemployment rates 50%, and they're just tired of it. And it becomes political backlash, and then the politicians feel like they have to push back. And I think that the Germany in particular, but the Euro area, the ECB, both have a very difficult challenge ahead, because if you negotiate with Greece, then you'll have anti-austerity parties in other countries saying, we want that too. If you let Greece go and they pull in Iceland and they devalue their currency, they have a short recession, but they come back swinging because all the Germans go to Greece for vacation because it's now cheap, then you have the risk that the market could think maybe someone else follows. Even if it wouldn't happen, just the risk that someone might think it is something that I think is so scary to a lot of European policymakers that at the end of the day, they probably will blink and take the slightly less scary path, which is a small negotiation, but both of them will spin it so they can look good in front of their domestic constituents.
But is that what the markets are assuming? Because obviously, aside from Greek debt itself, you haven't seen much sell-off in the other peripherals.
Yeah, I agree. Plus you have the ECB with quantitative easing kind of as your backstop now. Yeah. You have a Draghi put.
Yes, another question. Oh, John, yes. John Althus on the FT.
Oh, I'll stand up. 2 questions. First of all, I'm not sure I've heard the word China mentioned. Plainly reason for some concern there. What are the risks and the opportunities from China? Secondly, I'm not sure if I have been flogging this dead horse even longer than Philip has in Buttonwood, but I've been expecting margins, corporate margins, to revert to the mean for at least 5 years now, and they still haven't, and they haven't in this quarter. What are the prospects for corporate margins, and what are the prospects for earnings, particularly here in the US? Logically, if rates do begin to normalize, then you would expect that to have an effect on earnings.
Kyle did mention margins earlier, but so let's start with China. Ashvin.
Yeah, so, I mean, you've seen a worldwide decline in commodity prices just across, so forget about oil. And I think there's a strong China factor to that, which is, China was on this breakneck speed, and then they decided to have some reforms. And so what happens? There's a way of doing business in China that people understand, and now suddenly people don't understand how to do business in China. So everybody has to take a pause and say, what are the new rules, right? What is corruption, and what is acceptable, and what is not acceptable, and how do I get this built in record pace, apparently, but within the constraints. And so at some level, it was very positive what they did, right? They said, okay, whatever you're doing in the past doesn't work. Here are a new set of rules. But as a result, there's been a tremendous slowdown. Now, I do think that eventually it'll pick up, right? It's a bit like Japan. When you start dealing with countries that have fundamental issues that come from demographics, and they're trying to solve that, this stuff takes decades. So I think China will pick up, and there will be a increase in commodity prices that will be commensurate with it, but it'll be a slightly different path than what they did before. And of course, India is going to jump in that too.
Of course.
So
Rebecca, yes, and bear in mind the clock.
I'm watching.
Yes, yeah, exactly. Thank you.
We've been underweight emerging market equities for the last 2 years. To the degree we have emerging market equity exposure, some of it's in emerging Asia, not China, a little bit in Latin America, but not much there. China makes me nervous. I mean, on a positive note, the leaders have more flexibility than pretty much any other country in the world, and it's so opaque that they can hide issues for a long time. Which maybe serves them well for now, but might not for always. On the other hand, with the capital controls there, people can have deposit rates which get them nothing, or property. So you've had all this speculation in the property market. Now values are falling in the property market at a fairly rapid pace. Half of the debt in China tied in some way to property. That's a very scary set of circumstances to me. And I think different from 10 years ago, China's now the second biggest economy in the world. And if China has problems, we're all going to feel it immediately. So I kind of go back to, well, the US is still a relatively closed economy with 11% of our GDP coming from exports. We're all going to get hurt. Maybe Americans are hurt slightly less. But it's the next year, I think they'll manage through it. They'll do more rate cuts. They'll do more easing. The next 5 years, it's one of the things that keeps me up at night the most.
Okay. And Carl, maybe last word with you. One thing always strikes me about, again, land of the free market is people have immense confidence in the communist government in China to manage an economy when they would condemn the fact that government in China was trying to manage the economy so much. It seems a strange sort of... Anyway, but what's your view on China?
I mean, if command and control economies worked in the long term, we'd all be speaking Russian already. So at some point in time, it's too difficult to manipulate the variables in an economy of that size. And I think they had tremendous overinvestment in fixed assets in the financial crisis, and it pulled forward a lot of commodity demand from the industrial base metals. And now all of that CapEx is coming online in production, and that's why we're seeing these massive commodity declines. We don't invest in China because I agree with Rebecca. I don't know which numbers to believe and which numbers not to believe. So we follow it from perspective of global commodities, but we don't invest in it.